Hello, everyone. Welcome to the sixth, and I think this is going to be the final video for chapter 21, our discussion on sales tax. Um, the last couple videos we've gone through actually calculating sales tax using the regular and the quick method. In this video, I'm going to focus on going through some of the administrative and compliance rules surrounding sales tax filing. Um, so just to touch on it, other than the quick method, there is a simplified ITC method. This comes from if you didn't take the time to split out the sales tax amounts from your purchases, it's included in your cost. This method allows you to tally up all of those fully taxable purchases, and then you apply this fraction to isolate the sales tax portion. So this method only really applies to fully taxable purchases. It has a lot of exclusions, capital expenditures for real properties, any purchases that are zero rated, outside Canada, non-registrant. So we're not going to give you a question that has a bunch of fully taxable purchases plus a bunch of exclusions. So for that reason, we don't focus too much on having you guys do the simplified ITC method. It's at this point kind of easier to just do the regular method when you have the expenses outlined for you anyway. To go into the sales tax compliance and administration, the timing of the liability. So registrants remit sales tax in reporting period the customer is invoiced. So if I invoice a customer for say $1,000, I've collected sales tax on that amount. Even though they may not have actually paid me yet, I've incurred the revenue, so I will remit the sales tax. If I do not collect that receivable and it becomes bad debt, I can apply that bad debt as I can apply the sales tax portion of that bad debt against my next return. So it may not be the same period as the payment being received. ITC is claimed when invoices issued by supplier, even if the supplier's paid later. So it's the same thing. So I get my ITC for sales tax paid as soon as I get the invoice in. So I can match these transactions in a specific period when the expense and sale occurred. The assumption is I will pay them eventually, so I can just net them and remit the difference to the government now. So the government doesn't have to wait around for payments to actually be made. Taxation year. Fiscal year is usually the same as the income tax fiscal year. If it's a non-calendar income tax year, this for sales tax, you can use either the calendar year or the same year used for income tax purposes. So corporations especially might not use a calendar year for their fiscal year. So they might have a year end of say October 31st. But that third quarter ends September 31st. So it's possible that their sales tax quarters go from January to March, April to June, July to September, but their fiscal quarters are slightly off from that schedule. That can be the case, but often if the corporation's opting for an off calendar year, they will elect to have their sales tax quarters follow the same strategy as their fiscal year. So they can use either the calendar year or they can use their corporate fiscal year for income tax purposes. The filing frequencies are determined by the total annual taxable supplies made by registrant and its associated persons. If the annual taxable supplies is 1.5 million or less, they'll assign you a reporting period of annual, which means if you're still roughly a small business, you'll be filing your sales tax at the end of the year. You'll be doing an annual reporting. So I've had clients that December passes, and once you get to the end of your reporting period, you have about 1 month to calculate your sales tax remittance and pay it. So January 31st is a big month for annual filers to get all their sales tax payments in. You can opt for monthly or quarterly, and a lot of small businesses might opt for quarterly because if we're expecting to getting that we're going to get refunds, at least for the short term, we might not want to wait the whole year to file a return. we might file monthly or quarterly smaller returns to get those refunds more frequently. If we're between 1.5 million to $6 million, we're assigned a quarterly return. We can opt for monthly. If our business makes or if we sell annual taxable supplies of more than $6 million, so if our revenue is $6 million, we have to file monthly returns. So our HST returns are filed every month. So our May sales will be filed and paid by the end of June. Most businesses I've ever dealt with are $6 million of revenue or smaller. I've dealt with a lot of smaller businesses. So I most frequently see businesses paying on a quarterly amount, but I have dealt with some larger corporations that make more than 6 million in a year. So they'll have monthly. So this 6 million has to do with the revenues, the amount of taxable supplies that they're selling. So they would have monthly returns. The filing due dates, when you're filing a return, if it's a monthly filing, it's due 1 month after the end of the reporting period. For quarterly filing, due 1 month after the end of the reporting period. For taxable sales with an annual filing, you do have 3 months after the year end. So if you're filing an annual return, at the end of so let's say we have a calendar year, December passes, our monthly filers for December and our quarterly files will both be filing and paying before the end of January, but our annual files have until the end of March to get that money in. Extension to June 15th in some cases, but that would specifically be for sole proprietors that won't be filing their tax return until June 15th. But even then, I think you kind of have to get permission for that extra amount of time. Payments, installments, and interest. Payment is due when the return is due. So most HST payments are due within 1 month of the quarter of the period end. Annual filers. So because annual filing, you're remitting your amount once a year. If that owed amount is high enough, they might still require you to pay quarterly installments. So if you have 2 years in a row where you owed a fairly large sales tax amount, they'll say, okay, well, you owed $6,000. So how about you pay $1,500 each quarter, and then we'll reconcile at year end. The government will do this because they might, in the same way that we might opt for quarterly returns to get our refunds, the government might want those installments so they don't need to wait a full year to be getting that money. Interest on amounts owing and unpaid by due date. So if we file a return and we're not paying the balance, the interest rate that's charged to us is the prescribed rate plus 4%. If the government owes us a refund, they'll have, I think, about 30 days to pay, and then that interest will start accruing to them at the prescribed rate plus 2%. So the interest that they accrue to pay to us accrues at a slightly slower rate than owed amounts that we owe them. Amounts owed to corporations is only the prescribed rate. Late filing penalty. So we are supposed to file a return generally within 1 month of our period end. So if we're late, our penalty is going to be based on the amount we owe. Pardon me. So 1% of amount owing plus 0.25% per month to a maximum of 12 months. So 0.25% of 12 months is an additional 4%. So the penalty could be total after a year, 5% of our owed amount. There's a penalty of $250 where the CRA made a demand to file a sales tax return that's been ignored. So it might be that the sales tax either has not been filed, or maybe you haven't registered, you haven't been tracking your sales and don't realize you're over 30,000. So when they see your income return, they might say, whoa, you should be filing a return. And if you then still don't file, then they have an additional penalty of $250. Appeals, there's an informal procedure. You can just contact the CRA. If you have a dispute over your sales tax amount, you can contact the CRA informally to try and sort it out. If they don't want to help, or if they refuse to help, or if they just don't come to an agreement, then that informal procedure will evolve into a formal notice of objection. So the notice of objection needs to be made within 90 days after the date on the notice of assessment. So our period will end, we file our return within a month, we pay our balance, then the CRA will assess our return. So they'll look at, okay, how much was your sales? What's your HST collected you're reporting? If that calculation comes to the same amount, then they say, you're good, we move on. But if they say, hey, we're going to remove a certain amount of your ITCs, you have 30 days from that notice of assessment to say, no, those ITCs are owed to us. The notice of objection will be reviewed by the Chief of Appeals. And then if so, the review by the Chief of Appeals might agree with the CRA, might agree with us. If they side with the CRA, we can take them to court. We can go to the Tax Court of Canada. This procedure is very similar to the same procedure we use for personal tax returns. So if you go through Chapter 2, I think it has the steps of the appeal in more detail. The HST return follows a very similar practice. After this point, we get into more complicated sales tax rebates. We have the employee partner. We have the housing related rebates. Those rebates are a little more complicated than we want to get into for this course. So now that we've covered the compliance and administration, I think that's as far as these videos are going to go. You're free to continue reading on the textbook if you're curious about those details. But I think my expectations at least are up to this point in the chapter. So if you have any questions, feel free to send them to me. Otherwise, best of luck. And I guess I won't see you in the next video. Best luck on the final exam and the rest of your semester. Thank you.